We keep hearing it everywhere. The stock market looks expensive. AI is in a bubble. We're hitting all-time highs after all-time highs. You can see the milestones associated with the current bull market here, with the S&P 500 standing at 4,800 points in January 2024 and recently hit 6,700 in October 2025. And in fact, we've had 7 new 100-point milestones so far this year, even with that short-lived Trump tariff chaos along the way. Even Jamie Dimon, the CEO of JP Morgan, recently said that he believes there's a higher risk of a serious fall in US stocks than many investors seem to realize. So you can certainly see why, among all this euphoria, the average investor is questioning how long can it continue. The question is, are we actually in a bubble, or is this just how modern markets look? Higher valuations, higher optimism, and higher expectations. In today's video, we're going to break this down properly. We'll look at current valuations and what they really tell us, what that means for long-term returns, and whether the concentration of the S&P 500 is a reason to worry. We'll also talk about individual stock risk, particularly with AI, and I'll share how I personally think about this all as a long-term investor. But before we jump in, a quick reminder, this video is for informational and entertainment purposes only. I'm not a financial advisor and nothing here should be taken as financial advice. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results, and if you're unsure about anything, please consider speaking with a qualified financial advisor. Let's start with valuations, because this is the first thing most people point to when they worry about a bubble in the market. There are a few main valuation measures to look at, but let's start with one of the most widely cited, the Shiller price-to-earnings ratio, also known as the CAPE ratio or cyclically adjusted price-to-earnings. The Shiller PE takes the current price of the market and divides it by the average of the past 10 years of inflation-adjusted earnings. So instead of just looking at the latest 12 months of profits, it smooths things out over a decade to give us a fairer long-term view. As of now, the Shiller PE is sitting at 39.65. To put that into perspective, it's now higher than it was just before the 2022 tech correction, and only slightly below the extreme levels we saw at the height of the dot-com bubble in 2000. Resultingly, a lot of commentators are starting to ask whether we're repeating history. Back then, valuations looked unsustainably high, and eventually they were. But the tricky thing with valuation metrics and charts is that they only tell us that things look stretched compared to the past. It doesn't automatically mean that we're in a bubble and things are about to burst. Importantly, even if it does turn out to be a bubble, there is little way of knowing when exactly that bubble will burst. Valuations can stay high for a very long time, and timing entry and exit based on this can be difficult. However, what this does show us is that a lot of growth is certainly priced in and there are high expectations of investors. If AI does lead to some sort of revolution and huge earnings growth, then a high valuation compared to history may well be justified. The problem with comparing to the past is that previous crashes after expensive valuations usually happen because earning expectations fail to materialize. What we don't know is that whether current expectations will fail to materialize. If it was as easy as looking at a valuation chart to time the market, then I'd be a lot richer. Moving on, another good chart to look at is this one on the S&P 500 forward PE ratio by Yardeni Research. This one is a simpler measure and looks at the price of the market today compared to analysts' expected earnings for the next 12 months. The calculation is share price divided by forecast earnings per share. Looking at this, the forward PE for the S&P 500 right now is hovering around 22.5. What is really helpful with this chart is that it highlights when corrections and bear markets occurred. We can therefore see that, historically, bear markets have often followed periods of very high valuations. The last clear example was the 2022 tech sell-off, which occurred after the huge run-up in valuations during the COVID era. However, an important thing to note here is that over the past decade, the forward PE has been consistently higher than in the decade before it. That could suggest that perhaps the market's idea of normal valuation has shifted. Maybe it's because profit margins are so much higher, or because dominant tech companies have global reach and lower capital costs, all things worth looking into. Whatever the reason, valuations today are operating in a different context, which makes comparing them to, say, the 1980s or 1990s a bit less useful. So again, my point here is that it is clearly not as simple as drawing conclusions based on a high number on a chart. The last valuation metric I very briefly want to cover is the Buffett indicator, named after Warren Buffett, who once called it probably best single measure of where valuations stand at any given moment. It simply compares the total market capitalization of US stocks to the country's gross domestic product, GDP. Right now, that ratio is incredibly high, roughly 2.17 times GDP, or 217%, which on the surface sounds very alarming, especially given that Buffett has given this measure so much praise in the past. That being said, I do think that of all the measures, this is the most questionable nowadays. Simply put, S&P 500 companies today are global businesses. Apple, Microsoft, Nvidia, Meta, Alphabet, Amazon, we could go on. They're certainly not only earning in the United States. So comparing their combined value to just US GDP doesn't really make much sense in my opinion. The world economy is their marketplace, not just the US economy. So what do all these measures actually tell us? No matter which one you look at, the conclusion is pretty similar. The US stock market looks very expensive. As a result, because the US now makes up roughly 60+% of most global equity indexes, that naturally makes global funds look expensive too. This does not mean a crash is imminent, however. Valuations can stay elevated for a long time, sometimes years, without anything dramatic happening. The way I like to look at it is that high valuations tell us that the margin for error is a lot smaller. A lot of growth is priced in, so that growth has to be delivered, and the first sign of bad news can rock the market. It's not as simple as sell when valuations are high and buy when they're low. If only it were that easy. Markets are forward-looking. They price in not just today's profits, but expectations about the future. Before we move on, I just want to take a quick moment to thank XTB for sponsoring today's video. XTB have been around for over 20 years, and whilst they're a newer entrant in the UK stocks and shares ISA space, it's great to see such a competitive offering available to investors. The ISA has no account opening or maintenance fees and zero commission on stocks and ETFs, making it one of the cheapest ISA providers currently available in the UK. You'll also find over 7,500 stocks and ETFs to choose from, so there's plenty of variety, whether you prefer individual shares or a diversified ETF portfolio. Another feature I really like is that their ISA is flexible, which means you can withdraw and reinvest within the same tax year without affecting your ISA allowance. If you happen to hold cash in your account, the interest rate on uninvested funds is also impressive. It currently stands at 4.25% AER at the time of recording. Of course, please note that this may be subject to change. If you're thinking of getting started with investing or looking to move to a new provider, you can currently get one full share of Rolls Royce when you sign up through the link in my description and make a qualifying deposit. If you're watching on TV, you could also scan the QR code on screen. This is a limited time offer and terms and conditions do apply. Thank you again to XTB for sponsoring today's video. So, we've seen that valuations are high. The big question now is what that might mean for future returns. Historically, when markets trade at high valuations, future returns tend to be lower. Now, that doesn't mean markets are about to crash, it just means that the next decade might not look as exciting as the last one. If we look at Vanguard's 10-year return forecasts, they're forecasting US equities to deliver around 3.3% to 5.3% per year annualized. That's quite a bit lower than the double-digit annualized returns many investors have grown used to over the past decade. They also expect global ex-US equities to outperform US equities over the next 10 years. This will be partly because other countries currently have lower valuations, and historically, starting valuation levels have been a predictor of future returns. So according to this, expected returns are decidedly unexciting for US stocks. However, the big caveat, of course, these are just forecasts, and like all forecasts, they should be taken with a pinch of salt. No one can predict the future. And I'd imagine if we went back and looked at expected returns from 10 years ago, the forecast probably massively underestimated what actually happened. What these models can do is provide some sense of expectation. They remind us that after a long run of above average returns, markets may struggle to deliver such in the future. It's not a crash prediction, it's just the mathematics of starting valuations and earnings growth. That isn't Vanguard telling us we should necessarily avoid the US stock market. It's still home to some of the world's most innovative, profitable, and dominant companies, but it's a reminder to manage expectations and to maybe think globally rather than assuming US stocks will always lead the way. Speaking of dominance, one of the biggest drivers of these high valuations is how concentrated the market has become. So let's take a look at that next. Today, the top 10 companies in the S&P 500 make up roughly 38.5% of the entire index at the time of recording. That's one of the highest levels of concentration we've ever seen. In other words, if you own an S&P 500 ETF, a big portion of your money is being invested into a small group of companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, and Meta. This level of dominance naturally makes some investors nervous, especially when they compare it to historical concentration levels. As this chart shows, the median weight of the top 10 since 1990 is around 20%, so right now does seem comparatively exceptionally high. However, we can't ignore that the current top 10 are some of the most profitable, cash-generative businesses in history, with global reach and real competitive advantages. A look at the Magnificent Seven's EPS growth over the past 5 years, compared to the rest of the S&P 500, really shows that their dominant position is backed up by significantly higher earnings growth. So the question isn't just, is the market too concentrated? It's also, do these companies deserve to be this large? That's not a straightforward yes or no, but we do have to see it in the context of their earnings and global reach. If we look at the top 10 from the 1990s, we can see that the sector composition is completely different and composed of a lot of companies that are much less global than the tech giants that now top the list. Linking back to a previous point, it's also a good indication of how the Buffett indicator may have been a lot more useful in the past. Of course, though, whilst we can argue back and forth about whether the current top 10 deserve their significant weightings, it's clear that it does create some risk. It means the market's returns become less diversified and more dependent on those same companies continuing to perform. If one or two of them stumble, for example, if AI growth expectations disappoint, the impact on the entire index could be significant. Although, over the long term, a market cap weighted index always rebalances to reflect the state of the world. It's self-cleansing in that sense. Now, while index investors might feel a bit nervous about concentration but overall feel happy to ride out volatility and any potential bubble, individual stock investors should perhaps be a bit more cautious. The reality is that in every bull market, our social media feeds get flooded with screenshots of huge gains. Someone's always bought the right stock at the right time, but what you don't see are the thousands of investors who picked the wrong ones and lost money quietly. This is where survivorship bias comes in. It's a tendency to only focus on the winners that made it through and ignore all the failures that didn't. The classic example is from World War II. When engineers studied returning fighter planes to decide where to add more armour, they looked at where the bullet holes were most concentrated. But Abraham Wald pointed out that this analysis was backwards. Those were the planes that survived. The planes that got hit elsewhere and didn't make it back were the ones that really needed reinforcement. Comparing this to investing, those that pick the losing stocks and suffer catastrophic losses are unlikely to be the next TikTok stock picking guru with millions of views and tens of thousands of followers. Instead, those with the huge gains rush to post their screenshots, but we forget about the countless other investors who took the risk on individual stocks and lost money. As JP Morgan's paper, The Agony and the Ecstasy, points out, many stocks experience catastrophic losses, defined as 70% drops from their peaks and never recover. Strikingly, these losers were often rated as strong buys by analysts at the time. Now, this isn't a deep dive into stock picking, but I do want to make it clear that this video is about the S&P 500 and the wider market, not individual companies. The risk between the two are very different, and so are the outcomes if a bubble bursts. Historically, broad market indexes have always recovered, although, of course, there are no guarantees going forward. On the other hand, many individual stocks haven't, and that difference is what matters most for long-term investors. It's this context that brings me to my conclusion and my personal thoughts on whether the market is really overvalued, and what I'm doing about it as a long-term investor. So, are we in a bubble? Is the stock market really overvalued? Honestly, I don't know how anyone could possibly answer this question with any degree of certainty. Valuations can tell us when markets look expensive, but they can't tell us when or if that will change. The market could stay expensive for years, or it could correct next month. Nobody, not analysts, not economists, not even the most experienced investors, can predict that with any certainty. For me, I try to take a step back from all the noise. I invest with the mindset that volatility is normal and drawdowns are inevitable. If markets do fall, that's part of what I signed up for when I chose to be a long-term investor. My approach hasn't changed. I still invest regularly, I stay diversified, and I focus on time in the market, not timing the market. I also know that valuations, earnings, and sentiment all move in cycles. We've seen dozens of periods where markets looked expensive, and yet, over time, they found new highs yet again. So rather than trying to outsmart those cycles, I'd rather build a portfolio that can survive them. Now, that's just my personal approach. I'm not telling anyone what to do. You should always make your own decisions based on your own goals, time horizon, and own comfort with risk. If you're investing for the long term and you understand what you own, maybe this can all be seen as noise. However, if you're saving for something sooner or you can't handle large swings in value, then that's where it's worth reassessing your allocation and risk tolerance. Honestly, I'd argue that investing heavily in equities probably isn't suitable for someone with a short-term horizon or low risk tolerance anyway, regardless of how cheap or expensive the stock market is. In that sense, it's less about valuation and more about whether the investment itself is the right fit for you. At the end of the day, investing is personal. There's no single right answer. If you found this video helpful, be sure to leave a like and let me know your thoughts in the comments below. Thank you for watching, and I'll see you in the next one.